Hey everybody, this is John Parisi of Parisi Gray Wealth Management. I'm the managing partner. Today is June 13th, 2023, after market close. We last did a video for you 2 weeks ago on June 1st, where we announced that after 18 months of being underweight equities, we were now fully invested again at target weight to stocks and bonds. That being said, we've had quite a move since May 1st. We had a really big number this morning that I want to talk about. Tomorrow is the Fed meeting announcement, and today we had consumer price index, CPI, the measure of inflation, came in for the 11th consecutive month as being lower. It came in at 4% year over year. The survey was for 4.1%, so it came in lower than expected. It peaked at 10%, over a year ago. So that was a crisis. 10%, 4%. We think that's really the target where the Fed should be aiming. They have this 2% at all costs. We think that's very unrealistic and not necessary. 3 to 4% is a really healthy number for the economy, for things to thrive. And as such, as this gets priced into the market, right now it's basically 100% assured that the Fed is not going to go tomorrow. It's 63% that the Fed goes in July. We think they're done. Once you stop an interest rate path, like pausing hikes or beginning to stop cutting rates, it's really hard to get the market positioned properly and balanced so that you can pause the market in June and go again in July. So we think the Fed is done. Again, we don't think they've come to that conclusion yet or that they know it, but we feel good right now that the rates of the hikes of the last year are just beginning to dig into the economy now. And just ask yourself, if you're a single income earner, on a fixed income, and you are and you have a couple of kids, and what would you rather do? Pay 4 or 5% more a year in goods, or lose your job if they throw us into a deep recession, right? If a smart parent can move things around to provide for their kids and feed them, and transportation to school, etc., if it costs 4 or 5% more. But if you lose your job and you can't make a mortgage payment or a rent payment or buy groceries or pay for cell phones or gas, that doesn't make any sense to us. So we think the Fed is going to come to this conclusion over the next couple of months. 2% was unrealistic to us. It was a matter of globalization. Began in the 90s with NAFTA, free trade between Mexico, the US, and Canada. It then moved over with China opening up their markets, and all that cheap labor in emerging market Asia, like Singapore, Malaysia, Taiwan, China primarily, all that free labor and all the US manufacturing moved overseas. You added COVID, where we couldn't get our supply chains filled when everything was being bought to produce our products from overseas. And then you add Ukraine and Russia, the invasion by Russia, and all of a sudden, energy from Russia and wheat and grain from Ukraine all got shut down. So things have moved back onshore to all the countries. And yeah, it costs more in a modern country like America. We have laws. There's minimum wages, there's labor laws, there's labor unions that drive up the cost. So yeah, we're paying a little bit more, but I think paying 3 or 4% more is certainly better than paying 10%, but it's also better than having a severe recession where millions of people lose their jobs. So, since we last talked to you, the S&P is up 3.5% in 2 weeks. That annualizes out to over 85% a year. That can't continue. Since May 1st, when we got back in the markets, the NASDAQ is up almost 13%, 12.77%. That annualizes out to over 100% gain in a year. So that's not going to happen. So we think the markets have really run in here. The easy money was made back a couple of months ago when we were getting in. It's going to take a lot more dollars coming into the market to push it higher and a lot less coming in to push it lower. So we're going to be a little bit cautious here for the next few weeks. Doesn't mean it can't go higher. We call that bumping along the ceiling when our indicators are now overbought. It can kind of grind higher, but it's also susceptible to pullbacks and entry points in here. You have a 50-50 shot of making money or losing money, and we don't love those odds. So we're going to kind of pencils down and wait for a better pullback. But right now we're just enjoying this run. It's been really good. We've kind of called it right. And we'll watch the Fed tomorrow and see what they do. We expect them to be on hold. We expect rates to be done. We think the market is fairly valued, maybe a little overvalued between now and the end of the year. But if we can finish the year up, 12% on the S&P, and NASDAQ's up much more than that, then we think will be a really good year. But between now and the end of the year, expect some choppiness and some periods of deep drawdown. So I hope this helps. Just a quick update. If you have any questions, just call or email me. Have a great night, everyone. Bye.